Hello, everyone. Welcome to our webinar series on capital market development, China and Asia. This webinar series was initiated by ABFER and also the Research Center Becker Friedman Institute, China from University of Chicago, in collaboration with the 5 university, 5 schools in Asia. They are NUS Business School, Shanghai Advanced Institute of Finance, Department of Economics, Chinese University of Hong Kong, the School of Management Economics from the Chinese University of Hong Kong, Shenzhen, and also Tsinghua PBC School of Finance. And welcome again to our webinar series. And then we have great speaker and also great discussant today. And also we have a very interesting topic. Let me make an introduction about our speaker. He's Professor Tobias BERG. He's Professor of Finance and Head of Finance Department from Frankfurt School of Finance and Management. And he will give us the paper. The title of the paper is On the Rise of Payment Firms. Let's welcome Professor BERG. Yeah, you have 25 minutes. Remember, yeah.
So the paper I'm going to present is On the Rise of Payment Firms, and it's joint work with Valentin Burg and Jan KEIL from the University in Berlin, and with Manju PURI from Duke University, FDIC and NBAR. And let me show you a motivating graph that is the motivation of what we are doing in this paper actually. So what you see here on the x-axis is very simple, timeline from 1990 to 2020. And on the y-axis, you see shares of the finance sector market cap. What does this mean? So the data that is presented here is data from the United States. And we look at publicly listed firms there in the financial sector, and we classify them as either being, oh, wait a moment, now I have some technical problems here. Okay, we classify them as either being banks, as insurance companies, as brokers, dealers, and non-depository institutions, or as payment firms. And I'll discuss the details of our classification, how exactly, for example, we define payment firms in the following. But first of all, think about firms like Visa, MasterCard, PayPal, these types of firms. Okay, and what we observe here is that at the beginning of the 1990s, banks and insurance companies were dominating here the aggregate market cap of the financial sector in the United States. So they both made up roughly 40% of the market cap, with brokers, dealers, non-depository institutions making up a little bit more than 10%, and payment firms being rather small in terms of the overall market cap of finance or financial sector firms. What you then see in the 1990s is, first of all, a rise in this gray dotted line, these brokers, dealers, non-depository institutions. So this coincides with the dot-com bubble. This is not what we are focusing on here, but what we are focusing on is this gigantic rise of the payment firms' share in the finance market cap in the United States. And you see this starting from 2005 to 2010. And here at the end of 2020, actually the aggregate market cap of all payment firms exceeds the aggregate market cap of all banks in the United States. Okay, it also exceeds the aggregate market cap of all insurance companies and also the aggregate market cap of all brokers, dealers, and non-depository institutions. And when I look at typical finance conferences, I don't know, think about the AFA or so, we see a lot of sessions on different topics, but I've rarely actually seen a session on payments, at least from a finance perspective. And we want to look at this from the finance perspective, look a little bit at why are they so big nowadays, what has driven this rise in payment firms. Now, we argue that this rise of payment firms is one of the most significant changes to the US financial industry in the last decade. And what we're trying to do is, first of all, more or less descriptively document the rise of payment firms. When did it happen? How, is it correlated with certain economic factors? What about profitability of these firms and growth outlooks and so on? So this first part is largely descriptive in nature. And then in the second part, we draw on micro level evidence of an e-commerce firm. And we show that there's a clientele effect. So if you don't offer a particular payment type, so if you look at a typical e-commerce purchase, it's a European setting here, you have a lot of different options. You can pay with various credit cards, with PayPal, you have other options that I'll go into detail a little bit later on. But so it looks like a lot of competition and a lot of options available actually to make payments in e-commerce. But if you make one of these payment methods not available anymore, it turns out that a significant share of customers actually aborts the purchase. And we label this a clientele effect, where there's a certain clientele for a credit card or for a PayPal payment. Others might prefer other ways of paying. And so you really have to offer all of these. Otherwise, you would see a significant drop in revenues as an e-commerce firm. Yeah? And this explains from our perspective a little bit the presence of a lot of payment firms at the same time, which at the same time are able to actually achieve a rather high margin and profitability on their business. Now, let me start with descriptive statistics in the first step. Then I'll link the rise in e-commerce to the rise in payment firms, and then I'll provide at least a snapshot of this micro evidence from our paper. Now, first of all, let me talk about data, because if you look at standard databases, CRISP, CompuStat, there is not an SIC or an industry code for payment firms. Yeah. So we needed to find a more formal definition of this. So our data set includes firms that are listed and located in the United States, that either have SIC codes of 6.0, which we call banks, 6.1 and 6.2, which are the broker dealers and non-depository institutions, 6.3 and 6.4, the insurance companies, and then the payment firms. And the payment firms we classify based on a combination of the SIC code. So payment firms are frequently in 6099 functions related to depository banking, or 6141 personal credit institutions. And you also see a lot of payment firms which are classified with SIC codes outside of this 6 SIC code. In particular, PayPal, for example, would be classified as a business service. So we say the SIC code has to be either 6099, 6141, or a SIC code that does not start with 6. And at the same time, it needs to contain the word payment or merchant solution. Okay. So for some of the banks that are outside of the 6099 SIC code, you will also sometimes see the word payment, because they might be active in many different areas, in wealth management, payment, lending, and so on. So these would obviously not classify as a pure payment firms. So you can also see our estimate of the importance of payment firms is a little bit of an underestimate, because we only classify pure play payment firms as payment firms, and other banks obviously also receive part of their revenues from payment services. We cross-check that with Nielsen reports. So Nielsen reports is kind of the leading industry source on payment firms. And I've asked them, how do you classify payment firms actually? You talk about payment firms, and the answer is more or less it's based on common sense. If you look at a firm, you know whether it's a payment firm or not. But in terms of market cap, we have a more than 95% overlap with their definition of payment firms. And then the market capitalization is easy. Price of the shares at the year end times shares outstanding. Now, let me give you an overview about the top 10 firms in each of these categories. Now, first of all, if you look at these firms in red here, these are the largest 5 firms by market capitalization in the finance sector in the United States at the end of 2020. And you see that 3 out of these 5 firms are actually payment firms. So Visa, MasterCard, and PayPal. There's only one bank left in the top 5, even though number 6 and 7 is then a bank again. So JP Morgan here is that bank. And then one insurance company, United Health, which is a gigantic insurance company in the United States. Yeah, but it's not only about these firms at the top, but I was personally, when I first of all looked at this data, I couldn't fully believe it, at least. Even if you look at something, for example, on rank number 8 here, the 8th largest payment firm is Global Payments. And that's a firm that few people will know, even in the finance domain. The 8th largest bank is Bank of New York Mellon, which has only a market cap roughly 60% of global payments market cap. But I think almost everyone knows Bank of New York Mellon. Similar for the broker dealers, we have Blackstone here. I think there's no one who kind of doesn't know Blackstone, but even though here from a market cap perspective, it's smaller than Global Payments. And on the insurance sector, Travelers Insurance, also a retail dominated insurance company that many people will know. Yeah, so market capitalization of these payment firms has become very large, not only at the very top, Visa, MasterCard, PayPal, but also further down the rank. And to be very clear, I do not want to equate market cap with importance, with systemic risk, with any other measure that you might have in your head, or number of employees or things like that. So this is maybe a reflection, obviously, about the value that shareholders attach to these firms. And we're also mainly interested in why do shareholders attach such a high value to the payment sector. Now, let's look at some fundamentals here. This is the profitability measured as the return on
Excuse me, can I
here.
interrupt you? Can I have a quick interruption for clarification?
Sure.
In your previous slide, those are market values, right? What if you rank order them by market share of the payment type?
Market share of what?
Payments, the domestic and international.
Okay, so this is harder to say because these are in different parts of the payment share. So for a typical e-commerce transaction, you will have both the payment firm, for example, PayPal. Then within your PayPal account, you might have a Visa or a MasterCard that is backing this. And then the interchange fees from these card transactions actually go to traditional banks. Yeah, so it's not necessarily the case that they do separate transactions, but they might all be involved in the same transaction. Yeah, so therefore for me, it's very hard to rank this. And to be even more extreme, JP Morgan has the subsidiary Chase Payment Tech, which is one of the key processors providing, so to say, IT processing in the payment domain with extremely huge transaction volumes, but also rather small kind of amounts they receive per transaction. Okay, so therefore, sorry, I don't have the clear answer to this, just because it's not that someone is doing payments end to end, but everybody has a separate kind of niche in this area. In terms of profitability, these payment firms have increased profitability by roughly a factor of 3 in the last half of our sample compared to the first half of our sample. And I think, as is clearly visible from this graph here, have also significantly outpaced both traditional banks, insurance companies, and broker dealers in terms of their profitability. And we also looked at other measures, not only ROA, and you get a very similar picture. So it's not only kind of a big wish by investors that something good might be happening in the future, but the profitability of these firms already now is very high. If you look at market to book ratios, they are also obviously following this high profitability, they are also very much elevated. So we now have an average market to book ratio. So this is market capitalization weighted of roughly 7 for payment firms, compared to market to book ratios of between 1 and 2 for banks, insurance, and broker deals. Now, let me come to the second part of this kind of descriptive or rather descriptive exercise. So we looked at stock returns, at weekly stock returns, and wanted to answer the question, okay, what is the payment stock return most correlated with? So to do that, we first of all had to determine an index of payment firms. This was based on our definition of payment firms, and then we created a classical value weighted index. And then we regressed excess returns of this index on excess returns of the classical Standard & Poor's 500 industrial sectors and an e-commerce sector. And what you see is that payment firms are most sensitive to e-commerce returns, followed by consumer discretionary, and consumer discretionary spending in the US has gone more and more online. So for the normal day-to-day spending, people might still go to Walmart and buy milk and bread and butter, but a lot of the discretionary spending is actually done online now. It's less correlated with kind of traditional parts like energy, utilities, or real estate, for example. Now, you can do the same for traditional financials, excluding payment firms. And there you will see that traditional, in particular banks, are highly correlated with the returns of industrial firms and the returns of real estate firms. And I think this confirms a little bit common sense here. If we think about the traditional banking sector, yes, they have a lot of collateral in the real estate sector. They're extending a lot of loans, mortgage loans, and they also have a significant lending portfolio, typically towards these traditional, very capital-intensive industrial firms. So we see a completely different picture here of bank stocks returns that are mostly correlated with industrials and real estate. These are the payment firm stock returns that have a high correlation or sensitivity to e-commerce firms and consumer discretionary spending. And you can also do that in a little bit more formalized way. So running here the first stage of the Farmer-Macbeth regressions. So we created here what we call an e-commerce minus brick and mortar factor. So this is a portfolio which is long e-commerce and short in traditional brick and mortar stores that mostly sell, not online, but mostly sell via their brick and mortar stores. So this is obviously a market neutral portfolio, so it's a long short portfolio. And what you see is that the excess returns of payment firms, which are here the dependent variable, that they significantly load on this e-commerce minus brick and mortar factor. So whenever e-commerce firms outperform their brick and mortar peers by a percentage points, payment firms will outperform the S&P 500 by 0.2 percentage points roughly. Okay, and here we control for the Farmer-French 5 factors, but we can also do it in a different model, for example, with the Carhart momentum factor. These coefficients are here very stable, both across model specification, no matter whether you use a CAPM, Farmer-French 3, Farmer-French 5, or the Carhart model, but they're also very robust across different sub-periods or excluding certain kind of specific periods. If you do the same for financials, in particular, also for the banking sector, you see exactly the opposite result. So the traditional banking sector does not positively load on this e-commerce minus brick and mortar factor. Depends a little bit on which sub-period you look at, also a little bit on which model you choose. It's either a zero loading or even a negative loading that the traditional firms have on this e-commerce minus brick and mortar factor. Okay, so this is evidence here from stock prices that e-commerce and payment firms might be intimately linked. Now we proceed with micro evidence here. And the micro evidence actually comes from a single e-commerce firm that mainly sells furniture online. And the process at this e-commerce firm is, I guess, very similar as you will find it around the world. You browse a web page and decide what you want to buy. And then sooner or later you press the checkout button and say, now I want to check out, and enter the relevant information. And this e-commerce firm then offers a menu of payments. So you can pay via credit card, Visa or MasterCard. You can pay via PayPal. They have a buy now, pay later payment option. You can also pay via direct transfer, for example. So there's a menu of different payment options. And then you can select one of these payment options. And for certain payment options and certain transactions, there might be a sub-step where you need to verify yourself. I'll come to that in more detail on a later slide. And then hopefully for the e-commerce firm, the customer then at the end clicks on buying. I want to buy this item. Okay. And what we do in the following, we look at variations in the availability of payment types. So what happens if you cannot pay with credit card, or at least paying with credit card is made significantly more cumbersome via extra steps and checks and balances? Do people stick to their preferred payment types? Do they say, well, if I cannot pay with credit card, I rather abort my purchase? Or are people here a little bit maybe more like finance professors who say, well, I can use all payment types that is available. I know credit card, I know PayPal, I can do a direct transfer. So I might smoothly actually change from one type to the next if one is not easily available. And so at this e-commerce firm, we have a significant market share of PayPal. Actually, there's a significant market share of buy now, pay later. And I think that's a separate issue with very few papers on buy now, pay later so far, actually. So this might even be worth a separate carve out maybe for a buy now, pay later paper, because it has been in the spotlight, in particular in the UK and in the US, for regulators, where there have been some actions against or looking at buy now, pay later. Credit cards.
Tobias, you have 5 minutes.
Options. Thank you. Yeah, credit card and prepayments are the other options, and it's rather stable over time. At the end, we see an uptick in PayPal actually in the last part of our sample, which goes from 15 to 20. And this is roughly the time where you see that PayPal here, the thick black line increases, where PayPal started offering in Germany also buy now, pay later option. We cannot prove that this is causally due to buy now, pay later at PayPal, this increase in their market share, but it's at least here correlated with that one. Now, I want to highlight one analysis in the following, because we separately look at credit cards, PayPal, and buy now, pay later. And for each of these three types, we have a shock to the availability and or ease of use of that particular payment type. And what I want to discuss in the next 3 or 4 minutes is in particular the analysis on credit cards. And if there are questions on PayPal and buy now, pay later, I'll be happy to do that in the discussion. And otherwise, the details are in the paper. The analysis are otherwise very much in parallel. So if you see credit cards, you've seen most of it. Let me describe the credit card setting in a little bit more detail. So if you want to pay with credit card, there's going to be a check which is more or less based on a fraud score. So if you've always been using your mobile phone, for example, your credit card in Singapore, and now you access the internet via an IP address from New York, maybe because you had a conference there, then this will first of all raise a little bit alarms at your credit card firms. And so this is one item among kind of hundreds of data points that they analyze to get at something like a fraud check. And then if you score above a certain limit for this fraud check, then you will be subject to additional verifications. So you see on the x-axis the distance to the threshold. And if you're above this threshold, then they will ask you to enter an additional PIN number that many people actually don't even know for their credit card. So this significantly pushes up the hurdle for using this credit card in our setting. And if you're below this, you're not subject to these types of checks, or only in very rare kind of either random cases or in cases where the amount is very high. And what we see on the right-hand side is kind of already a key result of that part of the analysis. What we have here is a typical RDD setting. You have a certain threshold. Above this threshold, you are kind of treated in that sense. Here it's made harder to pay with credit card. Below that, it's very easy to use credit card. And what we see is that the likelihood of conversion on the left-hand side is around 75 to 80%. But once you're required to enter additional PIN numbers, you're subject to these additional checks, the conversion rate actually drops to 54%. So only 54% of these customers then continue to buy at the e-commerce shop. And when I talk about the conversion rate, the likely to purchase here, I do not only include purchases made with this credit card, but purchases in general. So there are very many people who, after they're subject to an additional check with their credit card, say, well, I might not have the PIN right away, but I'm also unwilling to use a different payment type because I'm always used to use credit card. So I'm unwilling to simply switch to a different payment type. And these differences between the 76% on the left-hand side and the 54%, 22 percentage points, or roughly a fourth in relative terms, fourth to a third, is obviously a significant drop in the conversion rate for the e-commerce firm. Keep in mind, what we are measuring here is the causal effect of this treatment. It's obviously only a local average treatment effect at this threshold that we can measure. Okay, we have the traditional checks and balances for an RDD, a histogram that there's no manipulation of the score, and then the formal regression discontinuity design that confirms these results that I've shown you in the graph. I'll not discuss the details on PayPal here, where we use outages as an exogenous shock to availability, and also the buy now, pay later. This is based on a regression discontinuity as well. Again, there's a significant shock to the likelihood of purchase in all three cases. So roughly a quarter of customers abandon the purchase if their preferred payment type is not available. Okay, so to sum up, we document, first of all, in a descriptive manner, the rise of payment firms in the United States. We show that the rise is closely linked to e-commerce via this stock return analysis, and we show there's a clientele effect. So customers' payment choices are really sticky. There's a reluctance to switch to other payment types if your favorite payment type is not offered or is not easy to use anymore. And we argue this can explain a little bit the existence of multiple payment firms that all have a significant bargaining power over e-commerce firms. Thanks a lot.
Okay, thank you, Tobias. Nice and good timing. And the discussant is Wenlan Qian. Wenlan Qian is professor of finance and real estate, and from U.S. Business School. And Wenlan.
Great. Can everyone see my slides?
Yes.
Okay.
Yeah.
Thanks. First of all, thanks a lot for the organizers to invite me to discuss this paper. So this is an area that I'm also interested in. I'm not working in exactly the same area. So this will be something that's complementary to my research and learning a lot from the paper. And I think Tobias has done an excellent job in sort of presenting the gist of the paper, which saves me a lot of time in sort of summarizing or repeating the paper's result. But let me just sort of give my start with a very sort of very brief overview of my reading of the paper. So the research focus I think is very straightforward. It's reflected in the title, and it's also very evident from the presentation. So this is a paper, or one of the first, if not the first, paper to look at payment firms as a subsector of financial intermediaries. And as we know from the presentation, that it has become an increasingly important type of financial intermediary. So that itself is very interesting, right? So that I actually, before reading this paper, I didn't expect that. But then learning and reading the paper give me sort of some new perspectives on the development and evolution of the financial intermediaries. So because this is something that few people or no one has sort of take a really serious look at it, I would call it a very ambitious question because it can inspire a lot of future research. So as a starting point, what the paper does is, of course, and when you start sort of like a new agenda, you want to document in stylized facts on this particular subsector of the financial intermediary. So Tobias has shown graphs and tables on the growth of the payment firms during the last 2 decades or so. And then that showed us some interesting sort of patterns. And then, of course, as economists, we're not going to be just satisfied by just looking at, oh, wow, payment firms have grown a lot. What we naturally will be curious is that actually what is the source of the underlying pattern, and what can we learn, or what kind of economic mechanisms can we actually get out of the patterns, or can we try to explore? So this is what they are trying to do. And I think there's a lot of room, even given the current draft, there's still a lot of room to explore further on the second part. Now, just sort of the way I read the findings is, I mean, just sort of very quickly repeat the findings. The first big part of the paper is just to show you the facts, right? So, and then the first part is basically they show that the payment firms have exponential growth, and both in terms of market cap and also in terms of profitability. The nice comparison here is that both in terms of market size and also some metrics of performance, that payment firms as a whole exceed those metrics of the banking sector. So that would give us a more sort of a straightforward or more illustrative sort of view of how the payment firms have been doing over the past decade or two. Then the authors conjecture that it could be related to the fast growth of the e-commerce sector. I mean, through even casual observations or just some sort of a reasoning, right? So then the way they want to push this direction is through 2 approaches. One is based on as a pricing approach, which is to look at the stock returns, okay? And then by documenting the stock returns co-movement between payment firms with respect to e-commerce, and then show that actually that the payment firms in general have a much very strong co-movement pattern with the e-commerce sector, but not the banking sector. So that the banks in general do not co-vary that not much with the e-commerce sector. So this is actually what I would think is the capital market suggestive evidence, or it actually shows a sort of a correlation pattern between payment firms and e-commerce. Now, the second approach is that the authors want to sort of push a little bit further, trying to come up with some micro level evidence to understand the mechanisms underlying the correlation between the co-movement between payment firms and e-commerce. So what they have is a large, very nice data from an online furniture retailer from Germany with a lot of transactions, and this retailer actually offers multiple payment options. That's the nice thing about this data. It actually captures the traditional payment method like credit cards, and like a more recent sort of a payment innovations like PayPal or buy now, pay later, or the installment, and so on and so forth. So, and Tobias has shown that what they've done is to sort of trying to identify in very creative ways to identify exogenous shocks that negatively affect the availability or the ease of using those payment firms to complete the transaction, and check how that actually affects the transaction probability or transaction success probability. And as you have heard, and maybe unsurprisingly, actually, that when as a consumer I do not have my preferred or my available sort of a payment option, the payment option that I have available from this website, then there's a significant probability that this intended transaction did not go through. Okay, so that's basically the summary of the paper. So as I said, I think this is a very interesting paper. So there's a lot of things to learn from this paper. So what I would do is to mostly, my comments are mostly 2 aspects. One is to try to sort of provide a little more thoughts on the stylized facts part. I think that's very important, because that actually is going to be very influential or to informative to give people an idea of how this payment sector is actually doing. And the second one, and the second main aspect of my comment will be focusing on the micro evidence, and then how should we interpret that micro evidence, and how can we relate the evidence to the story that you have in mind of the relationship between payment firms and e-commerce growth. Okay, so let's start with the stylized facts. I think the important part of this, and the first important part of this paper, is to convince people that we are actually measuring and identifying payment firms, okay? Because this is something that people have not done it before. So what authors have done is to basically use, I mean, they've done a lot of work. First use the SIC codes, and then augmented by sort of a business description keywords, and maybe also like some menu double check and so on and so forth. And as a result, they come up with 116 payment firms. Now, as an empiricist, and usually when you see something that's new, you're going to question, okay, how is the measurement? Is there any measurement issue, right? And then what I'm actually comforted by is this table, which actually shows, for example, the top 10 payment firms, of course, against the rest of the sort of a financial intermediaries. So one thing that's reassuring is that, let me see, you can actually see that the top 10 payment firms, they are all sort of known names, and then we know that they are actually specialized, or their main line of business is in payment solutions. Okay, so the measurement issue, I forgot to mention that either you worry that they're not capturing the right payment firms, meaning that you may be misclassifying some other, I don't know, like banks or whatever into the payment firms, or maybe even the payment firms that that we capture, maybe they contain some payment services, but that's not their main line of business. By looking at this top 10 firms, it's kind of like alleviating part of my concern, because you can even like search if you're not aware of some of those payment firm names, and they are sort of a dedicated payment, or their main line of business is actually to provide payment services. So that helps alleviate the measurement concern to a great extent. Now, the other sort of observation that I noticed is something that this is something that I also learned. This is a fact that I actually find it very new and striking and interesting, which is that you actually see a big concentration of the top 3 payment firms, namely Visa, MasterCard, and PayPal. Okay, so I did a very quick calculation. Among the top 10 payment firms, these 3 firms actually take over close to 70% of the top 10 payment firms in terms of market cap. So essentially, these are the 3 big players, if not the major players, at least among the top 10 payment firms, okay? And then if you compare that with the banking sector, it's even more concentrated in terms of the top 3. So the top 3 banks in the banks sort of a subsector is actually about 65%. It's not small, but it's still, I'm surprised that actually the payment firms is this much concentrated. Now, having said that, what I actually want to see a little bit more is a little bit more dimension or more investigation of the pattern that you document, which will give me a reader's even more information. So first of all, I want to have a idea. I mean, I didn't find it, maybe I misread in the paper, that I want to know what is the fraction of the top 10 payment firms relative to the entire sector. You have 116 firms, and these are the top 10 firms. I imagine that this is going to be the big chunk of the payment firm, but how large? Is it, 80% or 60% or something? So why do I need to know that? First of all, it will help me further validate your measurement, because then I know that even if you have potential misclassification of the smaller payment firms, but overall the relevance is actually less significant if they are collectively, they're actually a small part of the entire payment subsector. And the other sort of a takeaway from this additional information is that it will give me more information on the market structure. It will give me more information on the concentration and sort of of the payment firms. Okay, is it really sort of a concentrated or driven by a very few but very large payment firms, or is it less concentrated than I have in mind? And the other sort of a pattern that I want to see a bit more investigation and showcasing in the paper is on the time series trends. Right now, what I read from the paper is the aggregate trend for the payment sector compared to the aggregate trend of the banking sector. Now that's very useful. I understand that you're trying to make a point about the sort of a fast growth relative to the banking or industry, insurance subsector. But I also want to look at a decomposition. I mean, for example, I want to sort of maybe break it into, let's say, traditional payment firms like credit cards, because credit cards have been there for a long time. But there's also other types of payment firms that are more recent innovations that either provide support or streamline or consolidate the traditional business payment businesses. For example, like PayPal and Square and so on and so forth. Actually, I want to see, for example, given the current 2020 sort of a large size of the market cap, and given the evolution of the whole payment sector as a whole, which type of payment firms is driving the growth? Okay. And also, like, among the top three, like Visa, MasterCard, and PayPal, because they are so important, they're over like 70% of the top 10 firms. Which one of these firms, or which two of these firms, or are they all sort of growing at the same rate? Because that would also give me an idea to think about how to link your the pattern with the underlying story about, for example, e-commerce. Okay, I'll come back to that a little bit later on. Because these type of decomposition, the reason I choose this decomposition is that they are, I mean, roughly speaking, they have a different business model and they have potentially differential reliance on e-commerce or influence on e-commerce. So this is something that I will come back now, right? So here is the second part of the sort of a comment that I want to discuss, which is the interpretation of the micro level evidence. So the evidence is basically saying that the payment option availability is relevant or is important for transaction completion. Okay, so that's something that we already heard from the presentation. Now, the current interpretation from the paper is that it shows the payment firms' bargaining power vis-a-vis the e-commerce firms. Another way, or my reading, or another way to think about this is that the payment service actually plays a significant role for e-commerce. Okay, meaning that if the payment service, this is kind of like an infrastructure. So if I do not have a right or developed or mature or well-functioning payment service, it will deter the growth of the e-commerce. Now, it depends on what story you're trying to tell. So if I read your slides correctly, I think that the paper is writing in a very careful way, but from the slides and from the way I kind of read it, sense it, the tone of the paper or the pitch is still trying to go with the notion that the e-commerce is actually driving the payment service growth. I mean, my question is that I want to push a little bit more. Is the current evidence provide a complete sort of or is the current sort of exercise provide complete evidence supporting that kind of interpretation? So let me first push back a little bit more to say that, okay, so here is the evidence, which is that the payment option availability is important for e-commerce transaction completion. The follow-up question is that, is this finding unique to e-commerce merchants? Or in other words, hypothetically, if I have a data of offline retailer, and if I use similar kind of identification strategies and ask the same question, is payment option availability a significant or not a significant factor for offline transaction completion? Will I get the same answer? So imagine that if I go to a store, right? So I only carry credit cards, but if they only accept cash, I guess there's no other option that I either, I mean, I will have to abort the transaction for now. I either go to another store or I go back to, or go to an ATM to get cash and come back to complete the transactions, right? So I mean, I don't have that data or a result, but my common sense would tell me that it's possible that these finding is applicable to offline transactions or offline retailers as well. Or in other words, that payment service also plays a very important role, not only for e-commerce, but also for the offline retailers. Now, let's come back to your asset pricing result, which is that the payment firms is actually much more correlated with e-commerce. So these two doesn't really square. So that's why I'm trying to push a little bit more to say, how can we use the evidence, or how can we sort of come up with other sort of ways to sort of push more of the story that you're trying to go, the direction that you're trying to go. Now, you could also argue that, maybe payment firms is important equally for e-commerce and offline retailers, but there might be some other factors during the past decade that causes a spike in the demand for e-commerce. So there's some latent factors that drives e-commerce. And at the same time, because payment service is so important, so it will drive both the development of the e-commerce and the payment firms. Now, that's possible, but as economists, that actually I want to know a little bit more about what could be the latent factor. It will be more satisfying we know or can tell a more precise story of what's going on. Now, regardless, I actually want to ask the following question with just a food for thought. So can we also step back to think about how is e-commerce different from brick and mortar store retailers in the demand for payment services? Or in other words, what is special of payment services for e-commerce relative to brick and mortar? So here is something that I thought about. It's obviously very premature that are open for discussion. Again, just some food for thought. One idea is that maybe for e-commerce that we value more of the payment convenience, because one big difference between e-commerce and offline retailers is that pretty much for e-commerce, cash is out of the question. Okay, so there will be less for cash transactions compared to brick and mortar. But on the other hand, we know that credit cards are also used heavily in brick and mortar retailers. And then this is the US I'm talking about now. If we're talking about Asia, then we know that cash is actually much more prevalent for offline retailers. But in the US, actually, credit cards actually are already very sort of prevalent and popular. So the difference, I don't know how big that is. And the other thing is that actually the top two payment firms that we see in the table are actually traditional credit card firms like Visa and MasterCard. So I'm not sure that this can explain that. So that's why I would suggest you to look at the evolution within the payment sector now. Which type of firms or which firm is actually driving the growth of the payment firms? That will give us more information. Now, if actually we know that if it's let's say the PayPal or Square or other kind of a payment support solutions or whatever we call it, that type of firms actually are driving the growth, then we may think of other stories, as I will mention in the point 3. So the other possibility is that maybe for online e-commerce, that it also gives us more option or give consumers more access, greater access to liquidity and credit. Now, just for like for example, retailers can provide credit or liquidity facility either directly or actually usually collaborating with payment firms, right? And then one big difference between this and the traditional brick and mortar stores is that actually we can leverage big data. Okay, so that can help us provide more credit. So that will potentially drive demand for e-commerce and therefore also stimulates payment firms' growth. So in a way that
4 minutes.
Okay, 4 minutes.
Yeah.
Okay, so the buy now, pay later in the micro evidence is actually one example. That if I read it correctly, the current evidence suggests actually the availability of BNPL, it plays a stronger role. I mean, in sort of in facilitating the transaction completion in terms of probability wise. I mean, if you have a negative shock across those payment options, that if you do not have BNPL, there's a higher likelihood that the transaction doesn't go through. But then again, there will be the same caveat on the relevance of this type of sort of a story, because again, the top two payment firms are traditional credit card firms. So the final sort of possibility is that could be technology development or some other development that actually promotes sort of a new payment solution firms that, like I said, streamlines or consolidates a payment methods like PayPal, for example, a prominent example of PayPal. So then it creates it is differentially relevant for e-commerce, because then online, when we make online transactions or when we make online purchases, there will be even greater demand for convenience, because I don't want to always sort of take out my credit card and remember my credit card number. And also that might be a greater demand for privacy, so that any kind of those type of innovations that can actually facilitate the transaction completion. Now, if you have this, then that can potentially explain that the Visa and Master is also growing at the same time, because these are kind of like support type of solutions, because the underlying payment service is still being provided by Visa and Master, right? So if you have PayPal, usually it's linked to a credit card or a bank card. So it doesn't sort of have to sort of take away the Visa and MasterCard out of picture. Now, these are just like random thoughts that I have in mind. I don't know what it is, but I think that it might be helpful. I mean, to think about, okay, how is sort of e-commerce different from the brick and mortar stores in terms of their demand and reliance on the payment services. Now, 2 minutes or 1 minute?
1 minute.
Okay, so the rest are basically more minor sort of empirical questions. So one thing that I'll just mention this one and I'll stop it there. I'll share slides and discuss with Tobias later on. One is that I don't know for sure because I cannot tell from the way it's written. I don't know if the data is at the transaction level or are you able to identify a customer, because here the dependent variable is the transaction success dummy. So my question is that if I observe 2 transactions, will I be able to know that they're from the same customer or if they're from a different customer? Because that will give us very different interpretations, right? So because if it's from the same customer, but we're not able to identify it, so the fact that the first one did not go through, it could be because that the customer is going to go back, for example, to try to identify their PIN, credit card PIN, and come back to start a new purchase again because the previous session has expired, or I could come back to choose a different payment method, then labeled as a new transaction. So it might be that you're able to identify the customer. It's just not obvious from reading the paper. Something to clarify. Okay. Yeah, the other stuff are really minor, so I'll leave it here. And then I enjoy reading the paper a lot. I think this is very promising, and I look forward to learning more from your future work.
Okay, thank you, Wenlan, for the excellent discussion. Actually, we also have several questions from the audience. Before we go to the question from the audience and also panelists, and then maybe we give some time for Tobias to quickly respond to your comments. Is okay?
Yeah, thanks a lot, first of all, Wenlan. This is extremely helpful and all really very well appreciated. So indeed, the payment sector is concentrated and the banking sector as well. Actually, therefore, it was important for us also to show that even on number 8, they exceed kind of the size of firms in other industries. I very much like these ideas of decomposing it. We can easily drop the top 2 or 3 firms. We can do it by card networks versus these facilitator models versus processor models. We should do this. We will do that. So thanks for the suggestions. This should be done. And then I think you also highlight the point that gave us kind of most of the headache is this unique to e-commerce, and in which way does the causality go? And indeed, we don't have point of sales equivalents here, and there are several ways of getting at these. The firm where we have data from, they actually also have brick and mortar stores, but it makes up less than 1% of their sales. So we're kind of looking at whether we can actually get data from this one or not. The stock return data suggests that it's like e-commerce seems to be different from stock and mortar in terms of driving stock returns. And we've also started looking into fees of Visa, MasterCard, PayPal, and for all of these, you see actually that for e-commerce transactions, they ask for higher fees and more so than what would be, so to say, justified by the increased cost you might have in an e-commerce setting. And last but not least, we can identify customers, not only transactions, but indeed, we haven't done this in this paper because we didn't, in this version, because we didn't have the data yet. We've done it now. It slightly drops the coefficients, but only slightly. And sorry, very last point on the comment. You're absolutely right that buy now, pay later has the biggest effects among all. Yeah, and that was interesting to us to see. And I think indeed it has to do that you have this additional credit availability via buy now, pay later, and this is probably a separate interesting factor to highlight on its own. Yeah, I absolutely agree.
Okay, thank you. I can see that Zhiguo raised his hand. Yeah, Zhiguo, can you unmute your microphone?
Yeah, I am. Okay, good. Interesting paper, especially on the first part, which I guess I never paid attention to these payment firms. So I do have one banking question, which is that what's the, you're showing the market cap, but we know that a traditional bank, 90% of the balance sheet is actually on debt side, which is not part of the market cap by definition. And in some sense that when I see this picture, this table, I was a little bit surprised. Then I realized that just you're looking at the equity. So I would like to know the finance, the capital structure of these payment companies. That's the first question. Second question is related to Wenlan, which is a standard as a pricing question, which is, I would like to know your cash flows, the payment companies' cash flows, and relating to, let's say, e-commerce cash flows, not the stock market return, because that could be reflected by this new tech firm, this sentiment, whatever, these discount rate effect. So if you have a quarterly data, these are listed company these annual reports or quarterly reports, showing us the simple correlation about these different categories to the e-commerce, that would be very informative to me. Okay. That's all my question.
Thanks a lot. Very well taken. So on the cash flows, there is in the US actually data on e-commerce sales, and it correlates with these. It correlates with the revenues at these payment firms, indeed, and also with the profits.
But I would guess that it's more on Square, those things, I feel.
Yeah, we haven't done the sub-part analysis on how it correlates with which types of payments. We should do it probably. I think that's a very good idea. Statistical power can be an issue here, obviously, because if you have 10 years, if you have annual data, for example, on e-commerce sales in the US, it's a little bit more problematic. But we'll do that in particular on the sub-sector analysis, PayPal, Square versus Visa, MasterCard. We haven't done this. And then your market cap on the banks is very well taken. So I think there are two issues you can say. The one is, there are many banks in the US which are rather small, but which are not listed. They're not party of the market cap. On the other hand, the traditional banks also have between 5 and 10% of their revenues stem actually from payment services. Yeah. And we are currently in the process of disentangling both. If you look at call reports, you can obviously get asset shares and profit shares of publicly listed and non-publicly listed banks, but you also get an item which is called interchange fees, where you see exactly what traditional banks actually make from the payment part. And we're in the process of disentangling that, and I hope we will have it in one of the next versions. Yeah?
Okay, I see Jun also raised her hand. Jun, yeah. Jun, we can now hear you.
She's frozen.
Yeah.
Oh.
Anyway,
maybe Michael also has a question.
Right.
So Michael can jump in. Yeah.
My question, I'm actually just, I guess I'm just repeating the same question. One of the questions that Wenlan was asking, that is, why the increase or the growth of market cap of payment firms has to do with e-commerce. Probably it's a silly question from the perspective of the US, because you clearly see the division. But from, as Wenlan said, that from the perspective of Asian users, that it's not obvious at all. Now, the big tech companies everywhere, they're not just targeting e-commerce, it's everywhere, offline retails. You can also see high penetration rate of those big tech companies. But the thing is, in your data, for instance, is this a furniture retailer having kind of offline brick mortar stores as well? So you can see kind of the difference between online and offline sales or purchases. Is there any difference? Is it data available? Or if in the US or in Europe in general, so those payment firms kind of why they do not want to really penetrate into offline payment? Why do they stay away from that? So maybe this is I don't know. This goes beyond the scope of the paper. I would like to hear your thoughts on this.
Yes, I mean, no matter whether it's beyond the scope or not, it's, I think, interesting to discuss for sure. So first of all, the retailer here does have a few brick and mortar stores, but they are responsible for less than 1% of their revenues. Okay, and can you still hear me? Because I get a sign that my connection is unstable. Can you still hear me?
We can hear you.
Okay, yeah. You can, perfect. Now, we haven't looked at this yet. We still need to get the data on this one and see whether the same kind of thresholds apply so that we can do the analysis. In general, I have the feeling that payment adoption is very much path dependent and very significantly from region to region. Just adding to your experience from Asia, I was recently in Copenhagen and in Denmark, and their PayPal is close to non-existent in e-commerce. And it always struck me that this is so path dependent that even in neighboring countries, which are otherwise very similar like Denmark and Germany, you see such a different adoption of different payment methods. To me, it supports a little bit this stickiness argument that there's not one dominant technical solution worldwide that everyone easily adapts once it's there. But people have a habit of using something, and once they have it, they want to stick to it.
Okay, thank you.
Yeah, while we are waiting for the reconnection, Jun.
Hi, can you hear me?
Okay, you are back. Yeah.
Yeah.
Sorry
about earlier. It's very interesting paper. I also like I like the first part much better. Also, I feel that the two parts actually should not belong to the same paper. So it's really interesting to see the rise of this payment sector. It calls for an SIC code that adds payment as part of a new code. But I keep struggle, and also their link to the e-commerce is pretty convincing. It's like in China, we have the e-commerce called Alibaba, and then we have this payment company called Ant Financial. So I guess it's an obvious fact, but I keep thinking, what more can you do with this? Once you identify this industry, what more can you do? I wonder if exploring, like Michael said, exploring international evidence might be more interesting than just jump into the micro factor. I guess if you could really establish that payments could have an impact on the rise of e-commerce, I mean, have a real impact, that might be interesting. Otherwise, payment is probably just a plumbing for the new age. So in that sense, whenever e-commerce calls for a new form of payment, it will arise automatically. I mean, if there are cross-international evidence where some countries are more friendly to that rise of new payment, while other countries like the US probably is not as friendly. That's why, the payments are still serviced by credit cards. So maybe that direction would be more interesting than the micro direction. And also I look at the plot of ROA and mark to book. It looks like they really took off in the around 2007. So I wonder if it has anything to do with iPhone and all these new handheld devices. So these are my reactions of the paper. Very, very interesting first half of the paper, and these plots and this summary are really stimulating. Thanks.
Yeah. Thanks a lot, Jun. So this is extremely highly appreciated, and it might come to existence very quickly, what you said. So we indeed debated whether it's best to split these papers up, so these parts up, because indeed in the second part there's a strong evidence that buy now, pay later dominates these other payment types in terms of the conversion rate. So there seems to be a big kick, so to say, from buy now, pay later on conversion rates, even bigger than for the other ones. That might be a separate paper indeed. Now on the international evidence, actually, I think it will be really interesting, but it might also be a fully separate paper actually, because there's so many regional differences across different areas of this world, regions in this world, which I think are interesting to explore, where I think there's a lot of path dependency there actually going on. What we'll definitely do is, just to add to the first part, is to look at whether something like central bank digital currencies, I mean, there are a lot of announcements by the Federal Reserve and ECB, for example, whether this has any effect on the on market book ratios, stock returns, market positions of these payment firms. And we've also frequently received the question, what about stable currencies, cryptocurrencies? The original idea was always to kind of replace or use them for payments. So do we see any correlation or evidence there that that kind of the prominence of cryptocurrencies, of stable coins, that they actually affect payment firms? So I think this might be one way we are going into central bank digital currencies, but also cryptocurrencies, stable coins, how that affects payment firms' rise. And the international evidence, as I said, I think this will be extremely valuable. But I think this is a different paper, maybe also written by someone else, because it seems obviously a lot of effort, but also a lot of like separate content you have for a separate paper if someone has a good international evidence of these differential paths that different regions of this world have taken. Yeah, thanks a lot, highly appreciated.
Okay, thank you. We also have some questions from our audience and from the Q&A chat box. I'm sure whether Tobias, you can see it or not, but anyway, and some of the questions actually answered, and then maybe we can pick some. And one question actually correlated with Jun's question and also early questions about whether the growth of payment firm stimulates the growth of e-commerce, right? And then this is some research on it. And also he asked a specific question whether the promotion from the payment firms could increase the sales of e-commerce business or another way around. And also he has a question about the specific question, what is the specific business model for payment firms? And payment firms are actually directly linked to bank account, and maybe banks also could have a say on whether to send a verification code. And this is one group of questions.
Yeah. So maybe on the business model. So when you look at the payment value chain, there's typically one which is kind of customer facing, the acquirer. Then you have the card networks typically in between, mostly even if you pay with PayPal, for example. And then you have banks at the end who settle it in the bank accounts, or also provide the credit lines. And then sometimes across you have these so-called processors who typically provide specialized processing services, and makes sense to, as Wenlan also said, to probably look at these different sectors separately, more the customer-facing acquirers, the networks, and the processors. And on the question of causality, is kind of payment innovation driving e-commerce, or e-commerce driving payment innovation? I think, like, looking beyond the pure evidence, hard evidence we have, I think it only makes sense if it goes both ways. I couldn't imagine a situation where it's only one way, because if you have a good, efficient payment system, it seems trivial to me that this should push e-commerce sales, obviously. But once you have this, you have a certain market power. If it wasn't there before, and you have first of all created it, I think it's almost a necessity that you have market power for a certain amount of time. The exogenous increase in e-commerce transactions will obviously help you as a payment provider who has provided this specific solution that helps e-commerce firms to thrive. Are we able, within the scope of our paper, to exactly document both the causality in one way or the other, and say how important is the error in one direction and in the other? I'm a little bit skeptical, but I think sensibly thinking about it, as the people who have made these comments have done so, suggests that it needs to run both ways, actually.
Yeah, I agree. And there's another group of questions about the second part of the paper. The second part of the paper is about using the German data on the abandoned e-commerce transaction, right? For that part, and they ask about the alternative explanation, and so far it's based on the story of preferred payment story, and then there could be other alternative explanations, such as given that people may have more time to think about their purchase and then maybe become more rational and decide not to purchase. So it's not due to the payment method or due to the process of paying, and giving them a greater opportunity to consider whether they really want to purchase or not. And also they ask whether it is possible to follow up with the clients, and for those clients, do they turn to other retailers with preferred options, or they simply abandon purchase? Undoubtedly, you have the data, right? So you only have one e-commerce. You don't know the clients purchase in other business platform. Yeah, I know the data you work. Yeah.
Yeah, that we don't have from other payment platforms. What we now can do in the data, but weren't able to do until a couple of weeks ago, is that we can really follow customers across time. So we can also see whether a customer comes back or not. So we don't only have transaction level, but customer level data. The other thing I find really interesting, a little bit the mechanism behind it. Why do they actually board? So what we can do, but have not done yet, but I think it's an interesting idea. We can look at people who are more impulse shoppers, like you click on an ad, you buy immediately. Compare that to people who maybe put something in their shopping cart, but before even deciding to check out, wait 3 or 4 days, yeah, and then maybe compare different items, and after 5 days return to your shopping cart, or 5 hours or so, and then you click on purchase. These seem to be the people who have at least thought about it already, versus if you're one of these impulse shoppers, oh, I saw it on an ad, I click on it and buy it, and now it doesn't work technically. These might be more the people where rethinking the purchase might be a bigger part of the mechanism. Again, we haven't done this, but the data should give us the option to kind of split it by these more impulse shoppers and those who have already thought quite a while about whether they want to buy or not, then they hit buy, and then they experience these problems with the payment types. Yeah, so thanks for this suggestion. Curious to look into that one, actually.
Okay, thank you so much for the answers. And I think they are pretty well addressed. And I think we are up to the time. And so maybe we can wrap up. And I would like to thank Professor Tobias BERG, and also Professor Wenlan, and also our panelists and audience, and for all this nice paper, nice discussion, presentation, and questions. And thanks so much. And hopefully you will follow up. Or, sorry, Andrew. Yeah.
Yeah, just a quick announcement for the next seminar will be July 22, July 22nd. Yeah, I forgot who is the host actually.
I'm going to say that. So
okay, good. Just making sure.
So we are going to have the next webinar on July 21st, as Zhihua mentioned. The title of the paper is Road to Stock Market Participation. Especially is a timely paper when the global market investor panic. So maybe it's time to enter the market. The presenter is Professor Smith Oguava. Okay, thanks everyone, and look forward to seeing you on-site and in other place. Have a nice day.
Thanks a lot for having me.
Thank you.
Thank you.